Hello everyone, welcome to today's US Open live webinar. It is Thursday, May 25th, 10 minutes before Wall Street opens at our usual slot. I am your host, Nikos Zabouras, Senior Market Specialist at FXCM, and it has been an intense week with Fed speak and debt ceiling still in focus, and the repricing in expectation around the Fed's policy path, the hawkish repricing continuing, while Fitch put US debt in negative watch. So much more goes on. However, since the German economy has entered the technical recession, as today's data showed, UK inflation report raised chances for further tightening by the Bank of England, while the Central Bank of New Zealand signaled the end of its rate hiking cycle that sent the Kiwi into a nosedive. And on top of all of that, we also have chip designer NVIDIA surging in today's pre-market around 30% of the time after strong forward guidance sparked, of course, by artificial intelligence demand. Before, however, we get into all of that, let's please go carefully through the risk warnings and the disclaimers, and then we will start. Once again, please go over the risk warning and the disclaimers carefully. And bear in mind that what is discussed today does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling because we have a packed session today, many events to go through. Let me start with a brief comment on the quarterly results of chip designer NVIDIA. And of course, you can find more thorough commentary on the FXCM market analysis websites of your respective regions. The firm reported somewhat mixed results for the 3-month period ended in April 13. But the increasingly important data center division posted record revenues, and the strong forward guidance also stood out. This was driven by increased demand for artificial intelligence infrastructure, and the stock surges around 30% in pre-market as we head towards the open. Once again, you can find more analysis on that, written content on the FXCM market analysis websites of your respective regions. So we already have Euro USD on our screens. We'll start with that, talk about the latest around the Fed and the debt ceiling negotiations. Then we will move to the New Zealand dollar versus the US dollar and the RBNZ shock. Then we'll talk about the UK 100, the London Stock Exchange, and the UK inflation report, and round things off with the Nasdaq. So on the Euro USD front, the latest Fed speak remained hawkish, as Mr. Waller, for instance, who is a voter, appeared open to skipping a hike in March, but again, this is a critical wording, skipping, since he made clear that the terminal rate has not been reached. Furthermore, the minutes of the last policy meeting revealed that even though several participants thought that further policy firming after that meeting may not be necessary, some officials said that more tightening would likely be warranted. It is clear that the policy outlook is uncertain. We have been talking about it for a while, but policymakers have generally been hawkish and dismissive of rate cut hopes. markets have adjusted to that and keep adjusting to that, have pushed back the timing of such an outcome. At the time of recording, CME's FedWatch tool sees rates at 5% in December from 5.25% currently, much less dovish, let's say, than a few days back, while assigning the highest probability to rates peaking at 5.5%. It's a toss-up between this rate increase happening in June at the next meeting or skipping that and officials hiking at the July meeting. But again, the expectations are still evolving, so we need to keep an eye. In any case, the US dollar has benefited from this shift in expectations, and Euro USD is running another losing week, threatening key levels. Of course, the poor performance of the German economy does not help the common currencies. It could constrain the ECB. Today's data showed the second consecutive quarterly contraction for the German economy, which is the economic driver of the euro area, and that is, of course, the definition of a technical recession. On the other side of the Atlantic, in the United States, Q1 was revised higher to date, 1.3% in the US. Both of those things are not good for the euro. Immediate bias is on the downside, and the broader uptrend now looks a bit shaky. The pair is exposed to the critical 200 days exponential moving average that we're highlighting here. And this is important because if we go to the daily chart, you can see that this moving average, now the black line, had contained the late February, early March correction back into the H4 chart. And of course, we could see further decline towards the 2023 lows at around 1.0515, 1.0481. However, sustained weakness in this region is not easy, in my view, since the ECB maintains a far more hawkish stance and is still expected to deliver more tightening this year. Above the 200-day EMA, the pair can bounce back into the daily Ichimoku cloud, but we need a strong catalyst to return above the 200-period EMA, the black line that would give control back to the bulls. That's at 1.088, 1.089. Now let's move over to the Kiwi, the New Zealand dollar versus the greenback. The Reserve Bank of New Zealand on Wednesday actually, let's say where the New Zealand Bank stood, and that was at the forefront of monetary tightening. And on Wednesday, it raised again rates, but views the current 5.5% OCR as the terminal level in a pivot that surprised markets, which were anticipating more monetary firming. And of course, the Kiwi, the NZD USD, nosedive to its second worst day of the year and new 2023 lows as markets become more hawkish around the Fed at the same time that the RBNZ turned dovish. Now there is a clear risk of breaching 0.6025, but the next support at 0.5927, 0.909 appears distant at this stage. The relative strength index on the bottom is at the most oversold level since September. This can contain the fall at around this region and perhaps give the Kiwi a chance to rebound, but sustained and significant improvement in sentiment will be required for challenging the 200 period EMA at around 0.6230. Let's switch gears now and go to the UK stock markets. We don't typically comment here in this webinar about the UK stock market, but it's at a significant technical level, and we had important events from the UK this week. So let's go ahead and talk about that. Wednesday's CPI report from the United Kingdom showed a significant moderation in headline inflation to 8.7% year over year. Again, this is something you can find more commentary on written content on your respective FXCM market analysis websites. That was the lowest in more than a year. However, the core print surged to 6.8% year over year, the biggest increase since 1992. These figures actually maintain pressure on the central bank to deliver more rate hikes. The Bank of England had slowed the pace of tightening recently and has refrained from offering forward guidance, but has kept the door firmly open to more tightening. The UK reacted negatively. You can see this slump here to the CPI report and closed below the 38.2% Fibonacci of the March low April high advance. This brings 7,420 support into the spotlight, but a test will need fresh catalyst, and the 2023 low at 7,202 is distant for now. On the other hand, the relative strength index again points to the most oversold level since the 2023 low of March, and the index has tried to find some reprieve today, but still drops at this region here where we find the 200 days EMA and the 50% Fibonacci. If it can hold on those levels, a rebound would be reasonable, but definitely does not inspire confidence for returning and challenging the EMA 200 at 7.7677 region. And let's round things off with the Nasdaq, the tech-heavy index in the US. As we're already 3 minutes into the US session. The debt ceiling saga continues as negotiators have not come to an agreement. We did have some comments making the wires just a few minutes ago that there has been progress, but definitely no agreement. We're now just days ahead of the estimated default date, which could come as early as June 1st. House Speaker McCarthy had said that there are a number of places where we are still far apart, but noted that I do not think there will be a default, and expectations are that the two sides will reach an agreement. Credit rating agency Fitch, meanwhile, placed the US debt's triple rating on negative watch, exactly because of this uncertainty around the debt ceiling in the United States. This initially pressured NAS 100, but it manages to look past it and past the hawkish repricing around the Fed's rate path, and actually rises again today, helped by the NVIDIA surge that we talked about at the beginning. The technical outlook has not changed, as the index is on track to tackle 14,302, but early to talk about more. On the other hand, the above factors that we described can always weigh, and a return to the 200 period EMA is still likely at around 13 to 19. but a significant deterioration in sentiment would be needed for a bigger fall. Now, as far as what's ahead, we talked about how intense this week is. We talked about a lot of developments, but the main event is not until tomorrow, and this is the April PCE inflation from the United States on Friday. The core reading had inched lower to 4.56% in March, and headline had dropped to 4.2%. More recent April CPI release showed that both core and the all-inclusive indexes eased, but only marginally. In any case, inflation is still high and far from the Fed's 2% targets. Officials are data dependent, the policy path uncertain at this stage, so the outcome of this release will be significant. Fed's peak and debt ceiling remain closely watched, but congressmen will likely leave the Capitol for the long weekend. Next week, we will start on a slow footing as UK and US markets will be closed on Monday. That's it from today's US Open live webinar. Thank you for joining me. We will talk again on Tuesday at our usual time, 10 minutes before Wall Street opens.